Here's something that will completely shatter everything you think you know about trading success. I spent 3 years bleeding money in the markets, chasing every strategy, every indicator, every guru's secret method. I was convinced that somewhere out there was the perfect formula that would finally make me rich. But here's the brutal truth nobody wants to tell you. The moment I stopped caring about making money was the exact moment I became profitable. Sounds backwards, right? Almost impossible to believe. But stick with me because what I'm about to share will fundamentally change how you approach trading forever. This isn't some feel-good motivational nonsense. This is the harsh reality that separates consistently profitable traders from the 95% who fail. And if you're struggling right now, if you're frustrated watching your account shrink month after month, this video might be the turning point you've been desperately searching for. Picture this scenario. You wake up every morning and the first thing you do is check your trading account balance. Your heart rate spikes, your palms get sweaty. You're already calculating how much you need to make today to pay your bills, to prove to yourself that you're not wasting your time, to show everyone around you that trading actually works. Sound familiar? Because that was me for years. Every single day became this internal battle between hope and fear. Hope that today would be the day everything clicked. Fear that maybe I was just kidding myself and throwing money away. I'd sit in front of my computer screen for 12 hours straight, watching every tick, analyzing every candle, convinced that if I just worked harder, studied more, found the right setup, the money would start flowing. But here's what nobody tells you about this mindset. The more desperately you chase profits, the further they slip away. It's like trying to catch smoke with your bare hands. The tighter you grip, the more it escapes through your fingers. And the reason why is both simple and profound. When you're focused on making money, you're not focused on trading well. Think about it this way. Imagine a basketball player who's so obsessed with scoring points that he ignores defense, teamwork, and fundamentals. He might get lucky and hit a few shots, but over time, his obsession with the scoreboard destroys his overall game. That's exactly what happens to traders who are fixated on profits. They ignore risk management, they break their rules, they chase losses, they overtrade, all because they're watching the wrong scoreboard. The paradox of trading is that it rewards those who care least about its rewards. Professional traders understand something that amateurs never grasp. Trading is not about making money. Trading is about following a process so consistently that money becomes an inevitable byproduct. It's about building an identity around discipline rather than dollars. Here's where this gets really interesting. Most traders approach the markets like they approach every other area of life. They think success comes from effort, from grinding harder, from wanting it more. In school, if you studied more hours, you got better grades. At the gym, if you lifted heavier weights, you got stronger. In most careers, if you worked longer hours, you earned more money. But trading operates on completely different principles. In trading, the person who takes 5 trades and follows their rules perfectly will outperform the person who takes 50 trades based on emotion and impulse. The person who walks away when there's no setup will make more money than the person who forces trades out of boredom. The person who accepts small losses without ego will build wealth faster than the person who holds losers hoping to break even. This creates a massive psychological conflict. Your brain is wired to believe that more effort equals better results. But in trading, desperate effort often produces desperate results. Emotional effort creates emotional trading. Forced effort leads to forced trades. The harder you try to squeeze profits from the market, the more likely you are to make costly mistakes. Let me paint you a picture of what this looked like in my own journey. During my second year of trading, I had this rule that I would risk no more than 1% of my account on any single trade. Sounds reasonable, right? But when I was down for the month, when I was feeling behind, when I saw other traders posting their big wins on social media, that rule went out the window. I'd convinced myself that this next trade was different. This setup was too good to pass up. I deserved a bigger position because I'd been working so hard. So instead of risking 1%, I'd risk 3%, then 5%. I remember one trade where I was so convinced I was right that I risked 15% of my entire account on a single position. Guess what happened? The trade went against me immediately. I watched 15% of my hard-earned capital disappear in a matter of hours. But the real damage wasn't financial. The real damage was psychological. That loss confirmed every fear I had about myself. Maybe I wasn't cut out for this. Maybe I was just another dreamer who would never make it in the markets. The irony is that my analysis on that trade was actually correct. Price did eventually move in my predicted direction, but I had sized the position so aggressively that I couldn't handle the normal fluctuations. I got stopped out at the worst possible moment, right before the move I had anticipated. My desperation to make money had sabotaged my ability to make money. This is the trap that destroys most traders. They know what they should do, but their emotional attachment to making money overrides their rational decision-making. They break their own rules not because they don't understand the rules, but because they care more about the outcome than the process. Now here's where the transformation begins. What if I told you that the most profitable traders treat each trade like a scientist treats an experiment? They have a hypothesis, they test it with predetermined parameters, they record the results, and they move on to the next test. The outcome of any single experiment doesn't define their worth as a scientist, and the outcome of any single trade doesn't define their worth as a trader. This shift in perspective changes everything. When you stop defining yourself by your profit and loss, you start making decisions based on logic rather than emotion. When you care more about executing your plan than hitting a daily profit target, you naturally become more disciplined. When you focus on the process rather than the outcomes improve automatically. But this transformation doesn't happen overnight. It requires you to fundamentally rewire how you think about success, about money, about your identity as a trader. It means accepting that some days you'll follow your rules perfectly and still lose money. It means celebrating the trades where you cut losses quickly, even though they hurt your account balance. It means finding satisfaction in discipline rather than dollars. The beautiful thing about this mindset shift is that it removes the emotional volatility that destroys most trading careers. When you're not attached to making money, losses don't devastate you. When you're focused on improvement rather than income, bad days become learning opportunities rather than personal failures. When you measure success by consistency rather than profitability, you build the foundation for long-term wealth. Think about the best athletes in any sport. They're not thinking about prize money when they're competing. They're thinking about technique, about execution, about following their game plan. The money comes as a natural result of excellence, but it's never the primary focus during performance. Trading works exactly the same way. This is why simulation trading fails to prepare most people for live markets. When you're trading with fake money, you can execute your strategy flawlessly because there's no emotional attachment to the outcome. But the moment real money is involved, everything changes. Fear enters the equation. Greed clouds your judgment. Hope makes you hold losing trades too long. The money itself becomes the enemy of good trading. Professional traders solve this problem by making the money psychologically irrelevant. They risk amounts so small relative to their total capital that individual trades don't matter emotionally. They focus on statistical edges over long periods rather than daily profit targets. They measure their success by how well they follow their rules, not by how much they make in any given week or month. This doesn't mean they don't care about profits. It means they understand that profits flow naturally from good process. But good process never flows from chasing profits. It's a subtle but crucial distinction that separates amateurs from professionals. When you truly internalize this principle, trading becomes almost effortless. Not easy, but effortless in the sense that you're working with the natural flow of the markets rather than fighting against it. Here's the thing that most traders never realize until it's too late. Your relationship with money is the single biggest predictor of your trading success. Not your strategy, not your indicators, not your risk management rules, though those matter. It's how you think about money, how you react to gaining it, how you handle losing it, and most importantly, how much emotional weight you give it in your decision-making process. When I finally understood this, everything clicked. But getting to that understanding required me to confront some uncomfortable truths about myself and about what trading really demands from you as a person. Because here's what nobody wants to admit. Trading exposes every weakness in your character. It magnifies every fear, every insecurity, every self-destructive pattern you've ever had. The market becomes a mirror that reflects back your deepest psychological flaws. Most people approach trading like they're learning a skill. They think if they just study enough charts, memorize enough patterns, backtest enough strategies, they'll crack the code. But trading isn't a skill you learn once and then execute. Trading is a psychological battle you fight every single day against your own impulses, your own emotions, your own deeply ingrained beliefs about money and success. Let me share something that happened to me during my third year of trading. I'd finally found a strategy that was working. I was having consistent winning weeks, my account was growing steadily, and I felt like I'd turned the corner. Then I hit my first real hot streak, 5 winning trades in a row, each one bigger than the last. My confidence was through the roof. But something strange started happening in my mind. I began to believe I'd figured it all out. The rules that had kept me disciplined suddenly felt restrictive. Why risk only 1% when I could risk 3% and make 3 times as much? Why wait for perfect setups when I was clearly on a roll? This is where most traders destroy themselves, and I was about to join their ranks. The next trade I took was double my normal position size. It worked. The trade after that was triple my normal size. It worked too. By the end of the week, I was risking amounts that would have terrified me just days earlier, but I felt invincible. The market seemed to be handing me money, and I was going to take as much as possible. You can probably guess what happened next. The market humbled me in the most brutal way possible. 3 consecutive losses wiped out not just my recent gains, but months of careful progress. I sat staring at my screen in disbelief. How had I gone from feeling like a trading genius to losing more money in 3 days than I'd made in the previous 3 months? The answer was simple but painful to accept. I had started caring about the money again. The success had reactivated my greed, my fear of missing out, my need to prove something to myself and others. The moment I started thinking about what I could do with all the money I was making, I stopped thinking about trading well. The moment I started calculating how much I could make if I just increased my size a little bit, I lost sight of the process that had made me successful in the first place. This is the cycle that traps most traders. They experience some success, which makes them hungry for more success, which leads them to take bigger risks, which eventually leads to bigger losses, which destroys their confidence and sends them back to square one. It's a psychological loop that keeps people stuck for years, sometimes decades. Breaking free from this cycle requires something most traders aren't willing to do. You have to completely detach your self-worth from your trading results. You have to stop measuring your progress by your account balance and start measuring it by your adherence to your process. You have to find ways to feel successful that have nothing to do with making money. This sounds abstract, but it's actually very practical. When I finally made this shift, I started keeping 2 separate scorecards. The first tracked my financial performance, which I only looked at once per week. The second tracked my behavioral performance, which I reviewed after every trading session. Did I follow my entry rules? Did I stick to my position sizing? Did I exit where I planned to exit? Did I avoid overtrading when I was bored? The behavioral scorecard became my new obsession. I wanted perfect scores on process execution, regardless of whether the trades made or lost money. This shift in focus had an almost immediate impact on my results. When you're focused on executing perfectly rather than making money, you naturally make better decisions. When you're measuring success by consistency rather than profitability, you build habits that lead to long-term wealth. But here's where this gets really interesting. The less I cared about making money, the more money I made. It's counterintuitive, but it makes perfect sense when you understand the psychology involved. When you're not emotionally attached to the outcome of each trade, you can think clearly about risk and reward. When you're not desperate for wins, you can take losses quickly and cleanly. When you're not afraid of missing out, you can wait patiently for the best opportunities. Professional athletes understand this principle instinctively. A basketball player doesn't think about his contract while he's shooting free throws. A surgeon doesn't think about her fee while she's operating. They focus entirely on the task at hand, trusting that excellent execution will lead to excellent results. Trading demands the same level of present moment focus. This is why most retail traders struggle. They're constantly thinking about what the money could do for them instead of focusing on what they need to do to earn the money. They're calculating mortgage payments while they should be calculating risk-reward ratios. They're fantasizing about quitting their job while they should be planning their exit strategy. The market has a way of sensing this desperation. When you need the money, when you're trading with rent money or bill money, when you're trying to prove something to yourself or others, the market becomes incredibly difficult. It's almost like the market can smell fear and greed, and it punishes both emotions mercilessly. Conversely, when you approach trading from a place of abundance rather than scarcity, when you're trading with money you can genuinely afford to lose, when you're focused on the craft rather than the cash, the market becomes much more cooperative. Opportunities seem clearer, decisions feel easier, execution becomes more natural. This abundance mindset isn't just about having more money, though that helps. It's about shifting your entire relationship with trading from needing it to work to simply wanting to do it well. It's about finding satisfaction in the process itself rather than just the results. It's about building an identity around being a disciplined trader rather than a profitable trader. The beautiful thing about this approach is that it makes trading sustainable. When your happiness isn't dependent on daily profits, you can handle the inevitable losing streaks that come with any trading career. When your confidence isn't tied to your last trade, you can maintain objectivity in your decision making. When your identity isn't wrapped up in being right, you can admit when you're wrong and adjust accordingly. Most traders burn out not because they lack skill, but because they can't handle the emotional roller coaster of chasing money. Every loss feels like a personal failure. Every winner feels like validation. The constant ups and downs eventually exhaust them mentally and emotionally. They either quit in frustration or blow up their accounts in desperation. But when you approach trading with the right mindset, it becomes energizing rather than exhausting. Each trade becomes a small experiment rather than a make or break moment. Each day becomes an opportunity to improve your craft rather than a test of your worth as a person. The work itself becomes rewarding, regardless of the immediate financial outcome. This transformation doesn't happen overnight. It requires constant vigilance against your own psychological tendencies. It means catching yourself when you start thinking about the money instead of the trade. It means celebrating good process, even when it leads to losses. It means staying humble when you're winning and staying confident when you're losing. The traders who master this mental game don't just become profitable. They become consistently profitable over long periods of time. They build wealth systematically rather than sporadically. They enjoy their work rather than enduring it. They develop a skill that serves them for decades rather than burning out after a few years. The real breakthrough came when I realized that every successful trader I'd studied had one thing in common. They weren't trying to get rich quick. They weren't desperately chasing the next big score. They had built systems around consistency, around showing up every day regardless of how they felt, around treating trading like a business rather than a lottery ticket. But understanding this intellectually and actually implementing it are two completely different things. Your brain fights against this approach every step of the way. When you see a setup that looks perfect, every instinct screams at you to risk more than usual. When you're having a bad week, your ego demands that you make it all back before the weekends. When you see other traders posting screenshots of massive wins, your fear of missing out goes into overdrive. I had to develop what I call psychological circuit breakers, rules that weren't about the market, but about my own behavior. For example, I created a rule that after any loss, I had to wait exactly 15 minutes before taking another trade. Not because the market needed time to reset, but because I needed time to reset. Those 15 minutes gave my emotional brain time to calm down and my rational brain time to regain control. Another circuit breaker I developed was a daily profit cap. Once I hit a certain profit target for the day, I was done trading. This sounds counterintuitive when you're trying to make money, but it served a crucial purpose. It prevented me from giving back profits due to overconfidence. More importantly, it taught me that there would always be another opportunity tomorrow. I didn't need to squeeze every possible dollar out of every possible day. The hardest circuit breaker to implement was the loss limit. Not just a stop loss on individual trades, but a maximum amount I was willing to lose in a single day. When I hit that limit, the computer went off. No exceptions, no justifications, no telling myself that the next trade would definitely be a winner. This rule probably saved my trading career more than any technical analysis ever did. These rules felt restrictive at first. They felt like handcuffs preventing me from capitalizing on opportunities. But over time, I realized they were actually liberating. They removed the constant internal debate about position sizing, about when to stop trading, about how much risk was appropriate. The decisions were already made during calm, rational moments. All I had to do during stressful moments was follow the predetermined plan. This is where most traders fail catastrophically. They create rules during their rational moments, then abandon them during emotional moments. They know they should cut losses quickly, but when they're in an actual losing trade, they convince themselves this time is different. They know they should stick to their position sizing, but when they see what looks like the trade of the century, they double down. The market has an uncanny ability to present you with your most tempting opportunities right after your biggest losses. It's almost like the universe is testing your discipline at your weakest moments. I learned this lesson the hard way multiple times. After a particularly brutal losing streak, I'd finally get a setup that looked absolutely perfect. Every fiber of my being would scream to risk more than usual to make back what I'd lost. This is where discipline becomes everything. Building discipline isn't about willpower. Willpower is finite and unreliable. Discipline is about creating systems that make good decisions automatic. It's about removing emotion from the equation as much as possible. It's about accepting that you can't trust your feelings when money is on the line. One of the most powerful systems I developed was what I call the pre-trade checklist. Before entering any position, I had to answer 5 specific questions. What's my entry price? What's my stop loss? What's my profit target? What's my position size? What's my reason for taking this trade? If I couldn't answer all 5 questions clearly and quickly, I wasn't allowed to enter the trade. This simple checklist eliminated probably 80% of my bad trades. The trades where I was acting on impulse, on emotion, on hope rather than logic. It forced me to think through each decision deliberately rather than reactively. It made me slow down in a world that rewards patience but punishes hesitation. The profit target question was particularly important. Most traders enter trades with a vague idea of where they want to exit. They figure they'll know when the time comes. But when you're actually in a profitable trade, your brain starts playing tricks on you. Maybe it'll go a little higher. Maybe you should move your target further out. Maybe this is the beginning of a massive move and you'll regret taking profits too early. Having a predetermined exit plan eliminates this internal debate. You take profits when you plan to take profits, regardless of how you feel in the moment. This might mean you occasionally leave money on the table, but it also means you consistently capture the profits that are available. Consistency beats optimization every single time. The stop loss question was equally crucial. Most traders know they should use stop losses, but they treat them as suggestions rather than commands. When price approaches their stop, they start negotiating with themselves. Maybe they'll give it a little more room. Maybe the stop was too tight. Maybe they should average down instead of cutting the loss. But a stop loss isn't a suggestion. It's a recognition that your initial analysis was wrong and continuing to hold the position is now gambling rather than trading. Every moment you hesitate to cut a loss is a moment that loss could become bigger. Every rationalization you make to avoid taking a small loss brings you closer to taking a large loss. Position sizing might be the most important question on the checklist, yet it's the one most traders give the least thought to. They focus all their energy on finding the perfect entry, then risk random amounts based on how confident they feel. But confidence is not a reliable indicator of probability. Some of your most confident trades will be losers, and some of your least confident trades will be winners. Professional traders risk the same percentage of their account on every trade, regardless of how good the setup looks. This sounds boring, but boring is profitable. Excitement is expensive. When you risk the same amount every time, no single trade can destroy your account. You can be wrong 10 times in a row and still have plenty of capital left to capture the winners that inevitably come. The reason question forces you to articulate why you're taking the trade. Not just that it looks good, but specifically what edge you're trying to exploit. Is it a breakout from a consolidation, a retest of support or resistance, a momentum continuation, a reversal pattern? If you can't explain your reasoning in one clear sentence, you probably shouldn't take the trade. This reasoning becomes crucial during the trade. When price moves against you initially, which happens on many winning trades, you need to know why you entered the position. If your reasoning is still valid, you hold the position. If the market action has invalidated your reasoning, you exit regardless of whether you've hit your stop loss. Having clear reasoning also helps you learn from your trades. When you review your trading journal, you can see which types of setups work best for you and which ones you should avoid. Without clear reasoning, every trade becomes a random event, and you can't improve what you can't measure. The pre-trade checklist transformed my trading because it forced me to be intentional rather than impulsive. It made me slow down and think through each decision. It removed most of the emotional decision-making that had been sabotaging my results. Most importantly, it made trading feel more like a business and less like gambling. But even with perfect systems, even with ironclad discipline, even with complete emotional detachment from money, trading will still test you in ways you can't imagine. The market has infinite ways to humble you, to make you question everything you think you know, to push you to your psychological breaking point. I remember one particularly challenging period where I followed my rules perfectly for 6 weeks straight, and my account still went down. Every trade I took met all my criteria. Every stop loss I hit was exactly where it should have been. Every profit target I missed was because I stuck to my predetermined exit. By every measure of good process, I was trading perfectly. Yet I was losing money. This is when most traders abandon their systems. They start thinking their edge doesn't work, their rules are flawed, their approach needs to be completely overhauled. They begin the destructive cycle of constantly changing strategies, never giving any approach enough time to prove itself. But I had learned something crucial by this point. Short-term results are essentially random. Even the best strategies will have losing periods. Even perfect execution can lead to losses over short time frames. What matters is not whether you make money this week or this month, but whether your approach has a genuine edge over hundreds of trades. During that difficult 6-week period, I kept detailed records of every trade. I analyzed what went wrong, looking for patterns or flaws in my approach. What I discovered was fascinating. My analysis was actually quite good. I was identifying high probability setups correctly. My entry and exit timing was solid. The problem wasn't my trading. The problem was that I had hit a statistically normal but psychologically challenging losing streak. This realization was both comforting and terrifying. Comforting because it meant my approach was still valid. Terrifying because it meant that even when you do everything right, you can still lose money for extended periods. This is the reality of trading that most people can't accept. It's why so many talented individuals fail in this business. The market doesn't care about your bills, your timeline, your emotional state, or your need for validation. It operates according to its own logic, which often defies human intuition. Sometimes the most obvious trades fail spectacularly. Sometimes the trades you're least confident about work perfectly. Sometimes the market trends for months without giving you a single good setup in your chosen time frame. Learning to accept this randomness while still maintaining confidence in your edge is perhaps the greatest challenge in trading. It requires a level of mental fortitude that most people simply don't possess. It demands that you trust your process even when that process isn't producing immediate results. It asks you to remain patient when every instinct screams for action. This is where the money focus becomes truly toxic. When you need your trading to pay your bills, you can't afford to have losing weeks. When you're trying to prove something to others, you can't accept that sometimes good trading leads to losses. When you're measuring your worth by your account balance, every drawdown feels like a personal failure. But when you approach trading from the right psychological framework, these challenging periods become manageable. They're still difficult, but they don't destroy your confidence or derail your progress. You understand that they're part of the game rather than evidence that you're failing at the game. The traders who survive and thrive are those who can maintain their discipline during the worst of times. They're the ones who stick to their rules when everything seems to be going wrong. They're the ones who trust their process even when that process is temporarily unprofitable. They're the ones who view bad periods as tests of character rather than signs of incompetence. This is where the real transformation happens, when you finally stop fighting the market and start flowing with it. When you realize that your biggest enemy isn't the institutions, isn't the algorithms, isn't the market makers. Your biggest enemy is sitting in your chair, staring back at you in the reflection of your computer screen. Most traders spend years trying to predict what the market will do next. They study every pattern, every indicator, every piece of news that might give them an edge. But the market doesn't care about your predictions. It doesn't care about your analysis. It certainly doesn't care about your financial needs or your emotional state. The market is completely indifferent to you as an individual. And once you truly accept this indifference, something magical happens. You stop taking losses personally. You stop celebrating wins as if you're some kind of genius. You start treating both outcomes exactly the same, as data points in a larger statistical sample. I remember the exact moment this clicked for me. I was reviewing my trading journal from the previous month, looking at a series of trades that had gone against me. Instead of feeling frustrated or defeated, I found myself genuinely curious. What could these losses teach me? What patterns could I identify? How could I use this information to improve my approach? It was like switching from being a participant to being an observer. Instead of being emotionally invested in each outcome, I became fascinated by the process itself. The wins and losses became equally interesting because they both provided valuable feedback about my decision-making process. This shift in perspective changes everything about how you approach each trading day. Instead of waking up wondering how much money you can make, you wake up curious about what the market will show you. Instead of forcing trades because you need action, you wait patiently for the setups that meet your criteria. Instead of hoping for specific outcomes, you accept whatever the market gives you. But here's what makes this so difficult for most people. This approach requires you to give up the illusion of control. Most traders cling to the belief that if they just work hard enough, study long enough, find the right strategy, they can control their results. They treat trading like any other job where effort equals reward. The reality is much more humbling. You can control your process, but you cannot control your outcomes. You can control your risk, but you cannot control your rewards. You can control your behavior, but you cannot control the market's behavior. And the sooner you accept these limitations, the sooner you can start working within them effectively. Think about this for a moment. Every profession has elements you can and cannot control. A surgeon can control her technique, but she cannot control whether every patient survives. A teacher can control his lesson plans, but he cannot control whether every student learns. A farmer can control his planting and watering, but he cannot control the weather. In each case, the professionals focus intensely on the elements they can control and accept the elements they cannot. They don't take it personally when variables outside their control produce unwanted outcomes. They understand that their job is to execute their process as perfectly as possible and let the results take care of themselves. Trading demands the same approach, but somehow most traders never make this connection. They keep trying to control the uncontrollable while neglecting the controllable. They obsess over where price will go next while ignoring whether they're following their own rules. They worry about market manipulation while their position sizing remains random and emotional. The controllable elements in trading are actually quite simple. Your entry criteria, your exit criteria, your position size, your risk management, your emotional state, your preparation routine, your review process. These are the levers you can actually pull, the variables you can actually influence. Everything else, price movement, market volatility, news events, economic data, what other traders are doing. All of this falls into the uncontrollable category. You can try to predict these things, you can try to prepare for them, but ultimately you must accept them as given and adapt accordingly. When you focus your energy on the controllable elements, something interesting happens. Your results become more consistent even though you're paying less attention to results. Your confidence grows even during losing periods because you know you're executing properly. Your stress levels decrease because you're no longer fighting battles you cannot win. This is what I mean when I say I mastered trading when I stopped trying to make money. I didn't stop caring about profits entirely. I simply redirected my focus from outcomes to process. I became obsessed with execution rather than results. I found satisfaction in following my rules rather than hitting profit targets. The money still mattered, of course. I wasn't trading for charity, but money became a secondary concern rather than the primary driving force. It became a byproduct of good process rather than the goal of every trade. This subtle shift in priority made all the difference in my long-term success. Most traders approach this backwards. They set profit goals first, then try to figure out how to achieve them. They want to make a certain amount per day, per week, per month. They reverse engineer their trading around these financial targets. And this approach almost always fails because it puts the cart before the horse. Professional traders do the opposite. They focus entirely on process goals. They want to follow their entry rules perfectly. They want to stick to their position sizing consistently. They want to cut losses quickly and let winners run. They want to avoid overtrading and emotional decision-making. The profit goals take care of themselves when the process goals are met consistently. This process-focused approach also makes trading much more sustainable over the long term. When your satisfaction comes from executing well rather than making money, you can enjoy trading even during difficult periods. When your confidence is built on following rules rather than hitting targets, losing streaks don't destroy your self-belief. But implementing this mindset requires constant vigilance. Your brain will constantly try to pull you back toward outcome-focused thinking. After a big winner, you'll start calculating how much you could make if you just increased your size a little. After a series of losers, you'll start questioning whether your approach works at all. These are the moments that separate professional traders from amateurs. Amateurs get swept up in the emotion of each outcome. Professionals maintain their focus on process regardless of recent results. They understand that both winning and losing streaks are temporary, but good habits compound over time. The traders who master this mental game don't just become profitable. They become anti-fragile. They get stronger during difficult periods rather than weaker. They use losses as fuel for improvement rather than evidence of failure. They treat success as validation of their process rather than proof of their genius. This transformation doesn't happen overnight. It's not a switch you can flip or a decision you can make once and forget about. It's a daily practice, a constant choice to prioritize process over outcome, discipline over desire, patience over pressure. Some days you'll execute this perfectly. You'll follow every rule, accept every outcome with equanimity, and feel completely detached from the money involved. Other days you'll slip back into old patterns, checking your account balance obsessively, calculating unrealized profits and losses, feeling your heart rate spike with every tick. The key is to notice when you're slipping and gently redirect your attention back to process. Not to judge yourself harshly for being human, but to simply acknowledge the shift and make the correction. Like meditation, this becomes easier with practice, but it never becomes automatic. I developed a simple technique that helped me maintain this process focus throughout each trading day. Every hour on the hour, I would ask myself 3 questions. What am I thinking about right now? What am I feeling right now? What should I be focusing on right now? If I was thinking about how much money I was up or down, that was a red flag. If I was feeling excited about potential profits or anxious about potential losses, that was a warning sign. If I was focusing on anything other than identifying setups and managing current positions, I needed to refocus. These hourly check-ins became like mini meditation sessions. They pulled me out of whatever emotional spiral I might be falling into and reminded me of what actually mattered. They kept me grounded in the present moment rather than lost in fantasies about the future or regrets about the past. The present moment is where all good trading happens. When you're thinking about how much money you might make, you're in the future. When you're beating yourself up about a recent loss, you're in the past. When you're fully focused on what the market is telling you right now, you're in the present. This present moment awareness is what allows you to see opportunities as they develop. It's what enables you to cut losses quickly when your thesis is invalidated. It's what helps you stay calm during volatile periods when emotions are running high. It's the foundation of all effective trading. But staying present requires tremendous discipline because your mind naturally wanders toward outcomes. It's human nature to think about consequences, to imagine scenarios, to plan for the future. These tendencies serve us well in most areas of life, but they become liabilities in trading. The market operates in real time, but most traders operate in psychological time. They're always thinking about what happened before or what might happen next. They miss what's actually happening right now. They react to their memories and projections rather than responding to current market conditions. Learning to trade in real time rather than psychological time is perhaps the most difficult skill to develop. It requires you to quiet your analytical mind just enough to let your intuitive mind perceive what's actually happening. not to abandon analysis entirely, but to hold it lightly rather than gripping it tightly. This balance between analysis and intuition is where art meets science in trading. You need enough analytical framework to identify high probability setups, but you also need enough intuitive flexibility to adapt when conditions change. You need structure to guide your decisions, but you also need fluidity to respond to unexpected developments. Most traders lean too heavily in one direction or the other. They either become overly mechanical, following rigid rules that don't adapt to changing conditions, or they become completely discretionary, making emotional decisions based on feelings rather than logic. The sweet spot lies somewhere in between. Finding this balance requires thousands of hours of practice and self-observation. You need to learn when to trust your analysis and when to trust your gut, when to stick to your plan and when to adapt to new information, when to be patient and when to be decisive. This learning process never really ends. Even professional traders with decades of experience continue to refine their approach, to adjust their methods, to evolve their understanding. The market is constantly changing, and successful traders must change with it while maintaining their core principles. The core principles never change. Risk management remains paramount. Discipline remains essential. Process remains more important than outcome. But the specific applications of these principles must adapt to current market conditions, to your personal development, to changes in volatility and volume and participant behavior. This is why mechanical trading systems often fail over time. They're built on historical patterns that may not persist into the future. They can't adapt to changing market dynamics or evolving trader psychology. They work until they don't, and when they stop working, they often fail catastrophically. Discretionary trading, when done properly, offers much more adaptability. It allows you to recognize when conditions have changed and adjust accordingly. It enables you to see opportunities that wouldn't show up in a mechanical system. It gives you the flexibility to evolve your approach as you gain experience. But discretionary trading also offers much more opportunity for self-sabotage. Every decision becomes a choice point where you can either follow your discipline or abandon it. Every trade becomes a test of your emotional control and psychological preparation. This is why the money focus becomes so dangerous in discretionary trading. When you're making subjective decisions in real time, any emotional interference can lead you astray. Fear can make you exit winners too early. Greed can make you hold losers too long. Hope can make you take trades that don't meet your criteria. Removing the emotional charge from money allows you to make clearer decisions. When profits and losses become just information rather than validation or condemnation, you can process that information objectively. When your self-worth isn't tied to your trading results, you can adapt your approach based on feedback rather than ego. The feedback loop between your actions and market results becomes much cleaner when emotion isn't distorting the signal. You can see more clearly which of your decisions are working and which aren't. You can adjust more quickly when your approach needs modification. You can learn more efficiently from both mistakes and successes. This accelerated learning curve is one of the biggest advantages of trading without attachment to outcomes. When you're not defending your ego, you can acknowledge mistakes quickly and correct them. When you're not celebrating your brilliance, you can recognize luck for what it is and not overconfidence. Most traders get stuck in patterns that don't serve them because their ego won't let them admit these patterns aren't working. They'd rather be right than profitable. They'd rather protect their self-image than improve their results. They'd rather maintain their illusions than face uncomfortable truths. But trading has a way of forcing these confrontations whether you want them or not. The market will eventually expose every weakness, every blind spot, every area where you're fooling yourself. You can either embrace this process of exposure and use it for growth, or you can fight it and remain stuck. The traders who thrive are those who welcome this feedback, even when it's painful. They understand that every mistake is a gift, every loss is a lesson, every challenge is an opportunity for growth. They don't take market feedback personally because they know the market isn't personal. This depersonalization of trading results is crucial for long-term success. When you stop taking wins and losses personally, you can respond to them appropriately rather than reactively. You can celebrate process victories even during losing periods. You can stay humble during winning streaks. You can maintain equilibrium regardless of short-term results. Equilibrium is the goal, not the absence of emotion, but the presence of balance. Not the elimination of desire for profit, but the proper prioritization of process over outcome. Not the removal of all pressure, but the channeling of that pressure into productive action rather than destructive reaction. When you achieve this equilibrium, trading becomes almost meditative. You're fully present with what's happening in the market. You're completely engaged with your decision-making process. You're simultaneously relaxed and alert, confident and humble, ambitious and patient. This state of mind is where the best trading happens, not when you're trying to force profits from the market, but when you're simply allowing profits to emerge from good process. Not when you're fighting the market's movements, but when you're dancing with them. Not when you're desperate for success, but when you're simply committed to excellence. The irony is beautiful. The less you need trading to work, the more likely it is to work. The less attached you are to making money, the more money you're likely to make. The less you try to control outcomes, the better your outcomes become. This isn't mystical thinking. It's practical psychology applied to the reality of market dynamics. When you're relaxed and focused, you make better decisions. When you're patient and selective, you take better trades. When you're disciplined and consistent, you build better long-term results. But achieving this state requires you to fundamentally change your relationship with uncertainty. Most people hate uncertainty and try to eliminate it through prediction, analysis, and control. But uncertainty is the source of all opportunity in trading. Without uncertainty, there would be no price movement and no profit potential. Learning to be comfortable with uncertainty, to even embrace it, is essential for trading success. This means accepting that you'll never know for certain what will happen next. You'll never eliminate all risk from your trades. You'll never achieve perfect accuracy in your predictions. What you can achieve is perfect execution of your process, perfect adherence to your rules, perfect management of your risk, perfect acceptance of whatever outcomes emerge from that perfect execution. And when you achieve that level of process perfection, the money takes care of itself. This is the paradox that destroyed my old approach to trading and created my new one. When I stopped trying to make money and started trying to trade perfectly, I began making money consistently for the first time in my career. When I stopped focusing on being right and started focusing on being disciplined, my accuracy improved dramatically. The transformation wasn't immediate or easy. Old habits die hard, especially when they're tied to deep psychological needs for validation, control, and security. But with consistent practice and unwavering commitment to process over outcome, the new approach eventually became natural. Now, when I sit down to trade, I'm not thinking about how much money I want to make. I'm thinking about how well I want to execute my plan. I'm not hoping for specific outcomes. I'm preparing to accept whatever outcomes emerge from good process. I'm not trying to force anything. I'm simply showing up and doing the work. And the work has become genuinely enjoyable. Not because it's easy, but because it's meaningful. Not because it always produces profits, but because it always produces growth. Not because I've mastered the market, but because I've finally begun mastering myself, tearing myself. The transformation from desperately chasing money to simply executing process isn't just a trading strategy. It's a complete rewiring of how you approach uncertainty, how you handle pressure, how you define success itself. Most traders never make this shift because it requires you to give up the very thing you came to trading to get: money, at least temporarily. But here's what I discovered: when you finally let go of that desperate grip on profits, when you stop measuring your worth by your account balance, when you focus entirely on becoming the type of person who executes flawlessly regardless of outcome, something magical happens. The money starts flowing naturally. Not because you figured out some secret strategy or found the perfect indicator, but because you finally removed the biggest obstacle standing between you and consistent profitability: yourself. So if you're struggling right now, if you're caught in that cycle of hope and fear, if you're measuring every day by how much money you made or lost, I challenge you to try something different. For the next 30 days, don't check your account balance. Focus only on following your rules perfectly. Measure your success by your discipline, not your dollars. See what happens when you stop trying to make money and start trying to become the trader who deserves to make money, because that's when mastery truly begins.